All right, so picture this. A company sells $1 billion worth of new stock. Now, your first instinct, right? That's a huge red flag. It screams, we're in trouble. But what if I told you that hidden deep in the fine print, this wasn't a cry for help, but a massive power play? Yeah, let's dig into this. So that really is the million-dollar question, isn't it? Is this a sign of pure desperation, or is it a sign of total domination? See, on the surface, it looks like they need cash, and fast. But when you look closer, it might just be the opposite. A bold, strategic move to own their market. And trust me, the difference is all in the details, and we're going to uncover every single one. You know, for most of us, when we hear new stock offering, our brains immediately scream one thing: dilution, right? It's this fear that because there are more shares, our little slice of the company pie just got smaller. And yeah, that's the common fear. But what if that's completely missing the point? What if the real hidden signal here wasn't about the sale itself, but about the absolute giants who are practically breaking down the doors to buy in? Okay, so first things first, let's tackle what I'm calling the delusion deception. We're going to peel back the layers on this thing and see why that knee-jerk fear of dilution might just be a total illusion. So where does this story even begin? Well, like a lot of these Wall Street mysteries, it starts with a super dry, kind of boring government document, an SEC Form 8K filed on January 2nd. But buried in all that legalese wasn't just the news of the sale. Oh no. The real headline was how it was sold. That's the breadcrumb that leads us to who was lining up to buy. And that breadcrumb leads us to the absolute key to this entire story. It's a piece of the puzzle with a pretty weird name. It's called the green shoe signal. And I know, it sounds strange, but understanding this one little thing is how we unlock what was really going on here. So, what on earth is a green shoe option? Okay, think of it like this. It's a special clause, like a safety valve, that the big banks handling the sale get to use. It lets them sell up to 15% more shares than they originally planned. But here's the catch. They can only do it if demand is just absolutely ridiculously high. We're talking off-the-charts level of demand. Okay, so that immediately begs the question, right? Why would these massive banks, we're talking Goldman Sachs, BofA, Citi, why would they risk their own money buying millions of extra shares? I mean, these guys are not gamblers. They don't make bets unless they already know they've won. And that's the secret. Here's how it actually works. Step 1, the banks see overwhelming demand. Step 2, they exercise that green shoe option. But, and this is the crucial part, they don't do it and then go looking for buyers. No way. They only pull that trigger when they have giant institutional buyers, think massive pension funds, huge investment firms, already lined up and screaming for more shares than were even available. For the banks, it's a completely zero-risk, slam-dunk move. And boom, that changes everything. Using the green shoe option isn't just some little technical detail. It is, and I'm quoting here, the undeniable signature of overwhelming institutional demand. So you see, the whole narrative flips. The story stops being, this company is selling stock, and becomes, the biggest, smartest money on Wall Street is desperately trying to buy in. And this incredible demand, it wasn't just random. It was all laser-focused on one single price point. A price so important that it basically became a fortress, a real line in the sand, if you will. And that magic number? $27.50. Every single share. We're talking the original offering plus all those extra green shoe shares, all of them sold at exactly $27.50. Now you have to understand, this is so much more than just a price tag. When you have billions of dollars from the absolute largest institutions in the world, all flowing in at one single price, well, that number becomes something else. It becomes a statement. It becomes a highly fortified wall. This is what the analysis calls the institutional defense line. And it makes perfect sense, right? I mean, think about it from the bank's perspective. If you're Goldman Sachs and you just put all your biggest, most important clients into a stock at $27.50, you have a very vested interest in making sure that price holds. Your reputation, your future business, it's all on the line. And the sheer scale of this is, well, it's just mind-boggling. We are talking about almost 58 million shares, all trading at that one price. That's billions and billions of dollars of capital, all planted like a flag at $27.50. That's not just a line in the sand, that's a concrete fortress. So let's recap.
The company didn't just sell some stock. No, they established a powerful new price floor, backed by the biggest players in the game. And that brings us to the next very exciting part of the story, the $1.6 billion war chest. I mean, what do you even do with that much firepower? When the dust settled, the company was sitting on a pile of cash worth roughly $1.6 billion. Let's be clear, this isn't keep the lights on money. This is game-changing, industry-shaking capital that completely rewrites the playbook for what they can do next. And this is really the core idea of the whole analysis. We're not looking at dilution for survival, raising cash just to stay alive. No, what we're witnessing here is dilution for domination. This is raising a mountain of cash from a position of incredible strength, specifically to go on the offensive. So, what does an attack with $1.6 billion look like? Well, there are a few huge possibilities on the table. First, you could go for a major merger or acquisition. Basically, just buy out a competitor and swallow up their market share. Second, you could make a surgical strike, pay off all your high-interest debt, which would immediately make the company more profitable and boost its earnings. Or, third, you could launch a massive marketing blitz, just overwhelm the competition and capture the market while they're weak. So when you put all these pieces together, the green shoe signal, the institutional defense line, this new billion-dollar war chest, a totally new picture comes into focus. This isn't about survival, it's about domination. The main takeaway here is just so clear, isn't it? This wasn't some company in trouble, hat in hand, looking for a lifeline. Nope. This was a sharp, opportunistic move. They saw that Wall Street was desperate for their stock, and they leveraged that incredible demand to arm themselves to the teeth for whatever comes next. And that's the ultimate pivot in this whole story. The headline changed completely. It's not company needs cash. It's world's biggest investors rush to hand company a $1.6 billion war chest. Why? Because they have enormous faith in what this company is about to do. So that's where we're left. It leaves us with this one huge, exciting question. Now that they're armed with $1.6 billion and have the full public backing of Wall Street's heaviest hitters, what's the next move? That, right there, is the new billion-dollar question. And you can bet we'll all be watching to see the answer.